Investing can sound complicated. Many people imagine it involves staring at stock tickers all day. They think you need a finance degree to succeed. But what if I told you one of the most effective investment strategies is also the simplest? It is so simple, in fact, that you can manage it from your couch. This is the core idea behind the Couch Potato Portfolio. It's a passive investing strategy designed for regular people, not Wall Street wizards. Instead, the goal is to be the market by owning a little bit of everything. This approach takes the guesswork and stress out of building wealth for your future. A couch potato portfolio is for investors who want their money to work hard for them, without them having to do much work at all. It's a lazy, hands-off approach that has proven to be remarkably successful over the long term. For anyone who has ever felt intimidated by investing, this is your invitation to get started. It's a reliable, low-stress path toward achieving your financial goals. To build a couch potato portfolio, you need to understand its core components: index funds and exchange-traded funds, or ETFs. Think of a stock market index like the S&P/TSX Composite in Canada or S&P 500 in the United States. These are simply lists of the biggest companies in a country. An index fund doesn't try to pick winners. Its job is to buy all the stocks in a specific index and hold them. By owning a single Canadian index fund, you own a small piece of every major company in Canada. It's diversification in one simple package. An ETF is very similar to an index fund. The key difference is how they are bought and sold. Mutual funds are priced once daily. ETFs trade like stocks. For a couch potato investor, this difference is minor. Both are excellent tools for low-cost, diversified portfolios. Another critical concept is diversification. Don't put all your eggs in one basket. Spreading money across hundreds of companies via an index fund reduces risk. Poor performance by a few is cushioned by the others. The final piece is the difference between stocks and bonds. Stocks mean ownership in a company with higher growth potential and higher risk. Bonds are loans to governments or corporations in exchange for regular interest payments. They're generally safer and less volatile. A classic couch potato portfolio combines stock and bond index funds. That mix captures stock growth potential while using bonds as a shock absorber, creating a balanced, resilient strategy. Building your own couch potato portfolio is surprisingly fast and straightforward. You can get the core setup done in just a few minutes. The first step is to open an investment account. TFSA, RRSP. These accounts offer tax advantages that help your money grow faster. Open them at any major bank or at an online brokerage for lower fees. Sign up is as simple as opening a bank account. Once funded, choose your asset allocation. It sounds technical, but it's just picking your mix of stocks and bonds. Base it on your time horizon and your comfort with risk. Younger investors may choose 80% stocks, 20% bonds. Closer to retirement? Consider 50/50ths. A common starting point? 60/40ths. Now the easiest part, buying your funds. You don't need dozens of investments. You can be globally diversified with 1 to 3 ETFs. One simple option: Vanguard VGRO, VBL, iShares XGRO, XBL, BMO ZGRO, ZBAL. These funds automatically hold a diversified mix of global stocks and bonds. Choose VBL. You're buying a 60/40ths mix in one fund. Example, you have $1,000. Open a TFSA. Deposit $1,000, search VBAL, place buy order. That's it. You now own a globally diversified portfolio. Keep adding money regularly and buy more shares of the same fund. It truly is that simple to start building long-term wealth. One of the most significant advantages of the couch potato strategy is its focus on minimizing costs. Every dollar you pay in investment fees is a dollar that is not compounding for your future. Many traditional mutual funds charge MERs of 2% or more. On $100,000, you'd pay $2,000 annually, regardless of performance. ETFs typically charge around 0.25% or lower. On that same portfolio, your annual fee would be just $250. That's $1,750 savings every year. Over 30-40 years, the difference between paying 2% and 0.25% can amount to hundreds of thousands of dollars. The other key to success is maintaining your target allocation. Over time, different parts grow at different rates. In a good stock year, your 60% allocation might grow to 65%, while bonds shrink to 35%. This is where rebalancing comes in. Rebalancing forces you to buy low, sell high. You sell some well-performing stocks and buy more of the lagging bonds. Rebalancing doesn't need to be complicated. For most investors, checking once a year is enough. An even simpler method: rebalance with new contributions. If stocks are overweight, direct your next contributions to bonds until balance is restored. And if you've chosen an all-in-one asset allocation ETF, the fund manager does all the rebalancing automatically. You never have to think about it at all. Your wealth grows passively while you focus on living your life. The biggest barrier to investing isn't lack of money. It's fear of complexity. The couch potato portfolio systematically dismantles these barriers. It proves that successful investing doesn't have to be complex. In fact, simplicity is its greatest strength. This approach is for everyone: recent graduate, busy professional, pre-retiree, particularly powerful for those starting their journey. It provides a clear, simple, effective path forward. It gives you a plan you can implement immediately. Start with an all-in-one ETF. Be globally diversified with a single purchase. Focus on what you can control: your savings rate, your costs, your own behavior. It puts you in the driver's seat. Perfect for busy people with other priorities: career, family, hobbies. The strategy respects your time. After setup, managing the portfolio takes as little as 15 minutes per year. Automate contributions, let funds work, check annually. The most important step is simply to begin. The power of compounding rewards those who start early. Don't let pursuit of perfection lead to paralysis. This strategy is championed by experts and Nobel laureates. The tools to implement this strategy are cheaper and more accessible than ever. Open an account, buy a low-cost diversified ETF, commit to contributing regularly, then go back to your couch and relax, knowing you've made a brilliant move for your future self.